Hello everyone. I will start with chapter 4 in this lecture. This chapter is about return and risk. And these are the concepts that we will cover in this chapter. So we start with the concept of return. Return means any profit that we expect to earn from an investment. So this is the reward for uh, investing cash in any asset. So we look at different aspects of return in details. So what are the components of return? The first one is income. It means the periodic cash payments that we receive from the investment. The other component is capital gains. So this is the difference between the price at purchase and the price at sale or at maturity. If the price at sale or maturity is higher than purchase price, then we have capital gains. If it is less, then we have capital loss. And total return is the sum of income and capital gain or loss. In this example, we have the stock of two companies, Target and Discover. So we consider the investment over a 1-year period, the financial year 2017. So both stocks have provided dividend income to investors, and the share prices have changed compared to beginning of the year. So what we notice is both stocks have provided dividend, and that is part of the income. Target has capital loss because the share price has declined at the end of the year, whereas Discover has capital gain because the share price has increased at the end of the year. So the sum total of income and capital gain or loss is the total return from each stock. So why is return important? Why is this concept of return important? Because the rate of return helps us to understand how quickly an investor can earn from the investment. Higher returns means more wealth is generated from that investment. So we start with the historical performance. We look at the historical trends in an investment's return. It gives us some indication of future returns, but it does not guarantee that the historical trends will continue in future. Then we have expected return, that is what an investor expects to earn from an investment. If the returns provided by the investment is more than what the investor expects, then the investor will be more willing to invest in that asset. So this is the historical trends in returns from stock of ExxonMobil, both dividend income as well as capital gain or loss. So this gives us an idea about the return in each financial year mentioned in this table. So what is level of return? What is the magnitude of return? So it depends on internal characteristics of the company that is issuing the investment, whether it is stock or bond. So first is the type of investment. Stocks generally generate more returns than bonds. It also depends on the quality of the company's management, the kind of business that they are doing. So that has an impact on the return levels. The other factors are called the external forces. These are external to the company, like political factors, macroeconomic factors. These have an impact on the return levels. So a specific example of economic factor is inflation. So whenever inflation happens, investors expect higher returns. So that is how one specific economic factor has an effect on the return. Historical returns forms the basis for uh, thinking about future returns. So if we notice the different types of asset classes have achieved different levels of return. In general, stocks have generated higher returns in most of the countries considered here. And this is in comparison to long-term bonds or short-term bonds. An important concept related to return is the time value of money. Why is this important? It is important because we want to receive cash as early as possible. So if we expect future earnings, then we would want to compare it to at the present time. So that is why we have this concept of time value of money. So that helps us in understanding whether the investment is suitable or not. So what do? We uh, find the present value of the benefits that we will receive in future. So could be income, it could be the price at sale or maturity. And we compare it with the costs involved in the investment. So what we do is we discount the future benefits by an interest rate. So the interest rate is called the discount rate, which would be the returns available from a similar alternative investment. If we notice that the present value of benefits exceeds that of cost, which means the investment that we are considering will provide more returns than similar other investments. If the present value is less, then this investment will provide less return than other comparable investments. And if the present value of benefits is same as that of cost, then this investment will provide same return as similar investment. So these are some of the decision criteria that we can figure out from time value of money. And time value of money is calculated with a discount rate. So in this case, we have got the present value of benefits, income in different years, as well as payment of the maturity amount at the end of the term. So we discount all these cash inflows with a interest rate, and we find the total present value of our future benefits. So now we look at how to measure return. So we have understood what return is. So now we look at the details of how to measure return. There are different ways to measure returns, and once we can measure the return, we can compare which investment is more suitable for us. So we look at different measures in more details. The first is real return, risk-free return, and required returns. So nominal rate of return is the return on investment expressed in current dollars. It does not take into account the effect of inflation. Real rate of return takes into account the purchasing power or the effect of inflation. So the formula is real return is nominal return minus the inflation rate. Now, risk and return have a very close relationship. So most investors are generally risk averse. So they will only uh, assume more risk in their investment if they are compensated with higher returns. So the required return from an investment is the return that compensates investors for the risk inherent in that investment. So required return on investment is real rate of return plus inflation premium plus risk premium. So when we combine real rate of return and the inflation premium, we get the risk-free rate. So this is the return from a risk-free investment such as US Treasury bill. Now, since we are investing in a security other than US Treasury bill, so there is some additional risk involved, and investors expect to be compensated for that. So we add a risk premium to the uh, risk-free rate, and hence we get the required return on any investment as risk-free rate plus the risk premium. Another measure of return is the holding period return. This is relevant for investments of 1 year or less. So in this case, what we do is we find the return on an investment for the total period. So one is realized return, that is the income actually received from that investment. And the other is paper return. So that is the return which has been achieved but has not been passed on to the investor. So it is more notional or as per calculation. So realized return is actual because the income has been received by the investor. Paper return or notional return is something that is calculated based on the current state of the investment. So how do we calculate holding period return? So we find out the income during the holding period and any capital gain or loss during the same period. And then we divide it by the beginning value of the investment. And capital gain or loss is calculated by subtracting the end value of investment with the beginning value of investment. So we have different types of investment across different asset classes. Let's say we take the example of common stock. So in a financial year, common stock has provided dividend income. So that becomes part of the income. And there is a certain value of the stock at the beginning of the year and at the end of the year. That helps us to calculate the capital gains or the capital loss. And when we combine the dividend income with the capital gain or loss, we get the total return. And from there, we get the holding period return. The next measure of return is internal rate of return. So in this case, many investments are found to provide frequent income to the investor. So internal rate of return or IRR is a discount rate which makes the present value of cash inflows to the current price of the investment or the beginning price of the investment. So we can calculate internal rate of return using a financial calculator as well as Excel file. So you can go through the steps in more details in the textbook. So here the formula is given for both mechanisms. For example, the initial cash outflow for investment is $1,000 and the final payoff at maturity is $1,400. This is over a period of 5 years. So what is the internal rate of return for this investment? Again, we find the present value. We use a discount factor to find the present value of each future income stream. And that gives us the total present value. And we can use that income stream again to find the IRR, the rate, the discount rate, which makes the present value of future income stream equal to the present cash outflow or the beginning period cash outflow. The next measure is annual rate of growth. This is more relevant for investments which are more than 1 year maturity. So in this case, we want to find the annual growth rate. What has been the year-on-year growth on average? So that is the compounded annual rate of growth. It can also be calculated using a financial calculator as well as Excel file. So in this case, we take all the income streams and then we calculate the annual growth rate based on the total period during which the investment is held. So that's all in this lecture. So I'll continue with rest of chapter 4 in the next lecture. Thank you.